Let's start today's video with some current events. I'm going to begin by reading a few paragraphs published in an article by Bloomberg about the announcement made by wealth management firm Third Avenue that they are freezing redemptions from their Third Avenue Focused Credit Fund. It reads, quote, "Investors who piled into the riskiest corners of the credit markets during 7 years of rock-bottom interest rates are getting a reminder of how hard it is to cash out. With outflows from U.S. high-yield bond funds running at the fastest pace in more than a year, Martin Whitman's Third Avenue Management took the rare step of freezing withdrawals from a $788 million credit mutual fund on December the 9th. The firm's assessment that meeting redemptions would be impossible without resorting to fire sales has put a spotlight on the dangers for junk bond investors as the Federal Reserve prepares to lift interest rates as soon as next week. It's definitely a dark cloud over the market, said Anthony Valeri, a strategist at LPL Financial, a Boston-based financial advisory firm. Investor withdrawals are driving the high-yield market now more than anything. Institutions, hedge funds and mutual funds are being forced to get out, and unfortunately, that's pressuring the entire market. The sell-off in riskier debt, fueled by tepid global economic growth and a collapse in earnings at commodities companies, deepened on Thursday as news of Third Avenue's decision rattled investors. Yields on U.S. high-yield debt climbed to the highest in almost 4 years, putting the market on pace for its first annual loss since 2008, a Bank of America Merrill Lynch index shows. Growing tumult in credit markets comes 8 years after BNP Paribas SA helped spark a global financial crisis by freezing withdrawals from 3 investment funds because it couldn't, quote-unquote, fairly value their mortgage holdings. While Third Avenue said its positions have the potential to deliver returns over a longer investment horizon, Berwyn Income Fund's George Scipioli said that the similarities between today's markets and those before the crisis are getting too big to ignore. And that's the end of the first few paragraphs. Now this is interesting. We have a very large mutual fund that was being faced with redemptions, and the managers realized that in order to meet those redemptions, they would need to sell assets, namely bonds. The assets are low-quality bonds, and they are quite illiquid, meaning that in order to entice people to buy them, the owners would have to accept a much lower price. So let's take a look at what the price of the fund was doing over the past couple of years leading up to this event. Here's a chart of the ticker of Third Avenue Focused Credit for the past couple of years. It appears that investors in the fund have been getting a little nervous about the quality of the fund's holdings since about July of 2014. Gradually, the value of the fund has been declining, and it appears that at least until the fund halted redemptions, the trend in price decline was accelerating. One thing this highlights is that when any group holds a large amount of paper assets, they will each have in their mind that their holdings are worth a certain amount. That amount will be the number of shares that they own multiplied by the last trading price. The problem is that this mental notion of value is not an accurate reflection of the value they each have at their command if they all want to liquidate at once. It appears that the investors of the fund were starting to get a taste of what their holdings might actually be worth, and they wanted to get out before the assets were marked to their true value. That's not the most interesting thing about the story, though. The most interesting part is that the owners of the fund who waited until last week to get out now find that they can't even sell. Imagine being an investor with a significant position in this fund and being told that there is no way to get out. Think about that for a second. Of course, one might argue that this kind of thing should be expected when investing in junk bonds. But is this a lesson that only applies to junk bond holders? Let's talk about a recent SEC decision regarding money market funds. Not too many people know that the market rout that started in 2008 and culminated in early 2009, resulting in the largest government financial bailout in world history, started in the money markets. For those of you who don't know, the money market is a giant pool of short-term financial paper that many people hold as a cash equivalent. It's not really cash because it consists of bonds near maturity, but many treat it as the equivalent of cash. Well, in 2008, one of the oldest and largest money market funds, the $62 billion Reserve Primary Fund, broke the buck, meaning that they had to mark their net asset value down below $1 per share. They were holding a pile of Lehman Brothers defaulted paper. This caused a crisis of confidence that essentially caused the money markets to lock up, removing liquidity very quickly from the financial system. The emergency measures taken at the time were an attempt to prevent the entire world financial system from suddenly grinding to a halt. A recent result of the events of 2008 and 2009 is a decision that was reached by the U.S. Securities and Exchange Commission regarding money market funds. The gist of these changes are summarized in the first few paragraphs of this article published in the Wall Street Journal. It reads, "If you have cash parked in a money market mutual fund in a 401k or similar plan, you may want to start preparing for sweeping changes on the horizon." Effective October 14, 2016, the Securities and Exchange Commission plans to put in place new rules that will require certain funds to abandon their stable $1 a share value, and allow some funds to temporarily suspend redemptions or impose liquidity fees on investors withdrawing assets during volatile periods. The changes could affect millions of Americans, including those who invest on average 4% of their assets in money market mutual funds in a 401k or similar plan. The new rules also apply to money market funds held in individual retirement accounts and taxable accounts. So now we see that it's not just junk bond funds that might be subject to lockouts, but even money market accounts, which most investors treat as the safest of all assets. This is certainly something to think carefully about. So let's think about this a little bit more. I'd like to talk about a few financial terms and review their definitions. There are some subtleties here that many in our current era don't give much consideration. In light of current events, I think they should. So let's start out with the first financial term, and that is the word asset. So what is an asset? According to the dictionary, the word asset has a few different meanings. The first is a useful or valuable thing, person, or quality. The second is a property owned by a person or company, regarded as having value and available to meet debts, commitments, or legacies. The third definition pertains to military equipment. It is the second definition that's the most relevant to the current events of interest. So an asset is a property that is owned by a person or company, regarded as having value, and available to meet debts, commitments, or legacies. Asset is a very popular word nowadays, and people generally use the word to refer to financial assets. In the case of our Third Avenue focused credit fund, our investors had assets, which were the pooled bonds managed by the fund. Prior to this past week, most people would concur that the assets of the fund had value, though the opinion of that value was on the wane for the past year and a half. And for a while, the investors could call up the fund managers with a redemption request and sell their portion of the fund's assets in exchange for cash, which could then be used to meet debts, commitments, or legacies. So I think it would be proper to classify the fund holdings as assets, at least prior to the redemption freeze. Now here's a critical question. What are the fund's holdings now? If the investors cannot liquidate their holdings, do they still hold assets according to the true definition of the word? After all, they still have title to something, but they no longer have the ability to use these holdings to meet debts, commitments, or legacies. Give it some thought. If the investors are not allowed to sell, do they still own assets? This leads me to the second financial term that I would like to discuss: property. It is the first dictionary definition of property that is of interest to us. The dictionary states that property is a thing or things belonging to someone or possessions collectively, and it gives a legal clarification that the law defines it as the right to possession, use, or disposal of something. Now, while I think we can agree that our investors in the Third Avenue Focused Credit Fund owned assets prior to this past week, what can we say about whether or not they could consider the assets as their property? The investors certainly thought that the assets were their property. However, they learned this week that their notions were wrong. When the managers of the fund suspended redemptions, it made it clear that the investors did not, nor did they ever, have, as the law states, a right to possession, use, or disposal of something. What they actually had was a contract that said under certain circumstances they would have a right to take certain actions with their share of the assets. They did not really own property because they did not actually have the right of possession to that property. I think if you review the prospectus or shareholder agreements on just about any financial asset you own, you will find that although you might be able to classify them as assets, you cannot classify them as property because you do not have the right of possession. It's a subtlety, but subtleties can tend to be important during times of crisis. So now let's turn our attention to the third word, which is possession. After all, in order for something to be considered property, a person must have a right to possession. Again, it is the first definition that is of interest to us here. The dictionary defines possession as the state of having, owning, or controlling something. Legally, it is the visible control or power over something. It is distinct from lawful ownership because it requires control. It involves holding or occupancy. It is the right to possession that distinguishes property from an asset, and this was something the owners of the assets of Third Avenue Focused Credit did not have. And guess what? According to the agreements that you have with your financial institutions, it is also something that you do not have when it comes to your financial assets, whether we're talking about junk bonds or super safe money market funds. And this is something that the Securities and Exchange Commission has made very, very clear recently. We might even go as far as to say that you don't really have complete possession of your house, even if you have no mortgage on it. After all, twice a year you are compelled to pay property taxes on your house. If you don't pay those taxes, then the county or state will put a lien on the house. So, given that you don't have full control over your house, you cannot consider it to be a full possession, at least not according to the strict definition of the word. And if you don't really have full control over it, is it really property in the strictest sense of the word? Maybe. Maybe not. Just giving you something to think about. So now that we've taken some time to go over some definitions and discuss the subtleties, let's take a look at how the frequency of use of these different words, asset, property, and possession, have changed over time. I think you'll find this to be quite interesting. Here's a neat little tool provided by the Google Books application. If you type in a few words, the application will graph how frequently those words appear in the printed literature going quite a ways back in time. Here I have asked Google to graph the frequency of usage of the words asset, property, and possession. You can see that before the year 1900, the word asset did not appear very frequently at all, but the word possession and property were both quite important. What is interesting is that over time the word possession started waning in importance, and the word asset started to rise in importance. It's as if one was gradually replacing the other. But this should not be surprising. The wealth of Americans, which used to consist of freely owned real estate and either a handful of gold or silver coin, has gradually evolved into pure financial claims upon the attentions of others to deliver value at some point in the future. In other words, our possessions have gradually, over time, been replaced with assets. What distinguishes the assets with real property, as our investors in Third Avenue focused credit have learned, is control and the full right to possession. I personally think that the declining importance of the concept of possession is going to turn around at some point, and possession will once again be of prime importance to people. Remember the phrase, possession is 9/10 of the law? Well, it's not that the phrase is no longer valid. It's just that the phrase has been long forgotten. Don't forget this phrase, my friends. Possession truly is 9/10 of the law, especially in an era where the law no longer exists to protect the rights of the people.